it takes guts to actually like invest in something that is not sexy, right? It takes guts to like say, this has performed extremely well. I'm going to get out and I'm going to invest in a market that has gotten its butt kicked.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here today with Adam Penn. Hello,
hey, Dustin.
Adam. Hi. How are you?
Hi.
Hi.
We got that. We figured that part out.
We've got it down, man. These podcast intros, you know, we're pros now.
How's your day going?
Well, it's going well, sir. How about you? You've got several irons in the fire, don't you?
I've got like so many that the fire is starting to like fizzle
you
out.
Make the fire bigger.
Yeah. I need a bigger fire.
Yeah. Well, that's all right.
Keep pushing one day at a time. No, things are going good. We've got lots of good deals, and it's the business we wanted to do. It's been fun.
Yep, for sure. And it's the business and all the fun stuff and all the not fun stuff that comes with that. You can't really you can't get one without the other.
Yeah, that is true. So it is. No, things are going good.
Good. Well, we won't belabor the fact, but we have a guest today. Pretty excited about it. I don't know if Adam, you want to intro him?
Yeah. A friend of ours, Buck, he's got his own podcast, Wealth Formula, I believe, and that all will be linked in the show notes. I'm sure he'll talk about it a little bit too. But
Joffrey, just
Buck
because
Joffrey, yeah.
You have a tendency to
leave off the last names.
Just so our listeners are clear.
Okay. Well, it would be in the show notes too. But he's got a lot of listeners. He's got a pretty good channel. He's been doing this for
long time.
Almost a decade, a little over a decade now. Invested a lot of money with a lot of different people, done some great deals, and he's learned a lot. Was a board certified brain surgeon prior to this career of real estate and alternative assets. So got some interesting topics, and looking forward to what he's got. He's mainly a macro guy, but looking forward to what he's got to share with us today.
Yeah, it's going to be a good conversation. We will dive right in.
Well, Buck, thanks for joining us today on the Wealth Independence Podcast. Happy to have you here. Why don't we start off by you just telling our listeners a little bit about yourself?
Yeah. Well, you know, I've been podcasting for over 10 years. I started out podcasting because, oddly enough, unusual to this space, but I started out as a surgeon who was making a lot of money and wanted to figure out how to invest my money. And I was looking around at other podcasts and trying to listen to real estate stuff. I couldn't really find anything that was for me because I wasn't trying to escape a cubicle, right? I was a guy with some money already. And how do I build? How do I do this while I'm still a practicing surgeon and all that kind of stuff? So I started podcasting back, I started, I think, in 2014, and then I might have skipped a year at some point and then came back in 2016. You know, it's always kind of weird when no one's listening to you for a while, so it's a little demoralizing.
Yeah, talking to an empty room for a year.
That's right. So, you know, and then went back into it and have been podcasting ever since then. You know, I stopped practicing medicine, been full-time real estate, alternative assets, and, you know, various financial stuff outside of that. So yeah, that's the story.
That's awesome. And so I think one of your focuses right now is kind of macro trends. Do you want to why don't we start off there with where you see things are and some things that you've been watching recently?
Yeah, I think it's a very interesting time to live in, which is not a good thing, right? Listen, I think for us real estate types, the tricky thing is that, you know, when we're talking to investors and such, it is important to remember in all cycles of the markets that there's always something on sale. There's always something on sale. And right now, you can look and you say, is the stock market on sale? Absolutely not. Is gold on sale? Absolutely not. What is on sale? Real estate is on sale. Real estate, especially when I talk about multifamily, like, you know, which is my focus, it is the redheaded stepchild in the markets right now. But if you look at the fundamentals, it's really compelling to get in. This goes back to the Warren Buffett stuff about, you know, when people get greedy and when people are scared, do the opposite essentially, right? Right now, multifamily real estate, it just got whooped in the last 3-4 years. Got whooped. Prices are down 40, sometimes 50% on really quality assets that are performing.
Yeah, we're under contract right now on a building, and one sold across the street back in 22, and we messaged the broker and said, "Hey, can you send us the OM from back then?" And his one line response was, "Here's the OM. What a time to be a seller." And like 180 a door is what it sold for, and we're under contract at 120 across the street, same vintage. Just different times.
It's insane. It's absolutely insane. And if you go back in the cycles, this is probably, after getting out of comparing to the 2008 times, this is probably 2009 or not 2000, probably like 2010, maybe 2011, where, no one wanted to touch this stuff, right? No one wanted to touch this stuff. And trying to get people to focus on it was extremely difficult. But again, if you look at the macro picture, I think what you're seeing is, okay, we had some increases in inflation. We know where those increases came from. They came from an isolated event that hasn't completely resolved itself. It was the Iran debacle. Energy prices went up. That rolled into CPI going up. And core inflation went up too because, no pun intended, but oil spills into everything, right? Even non-energy type stuff.
It's the basis of everything else in the economy.
That's right. And if you look at what was happening in the economy before that conflict, every month inflation was going down. Every month. Core, CPI, everything was going down. And if you look at the big picture, there is a gorilla in the room that everybody knows, and it's called artificial intelligence. Artificial intelligence makes everything more productive. It makes things cheaper. So it is a massive deflationary force that we're coming up against over the course of the next 3 to 4 years. I'm not here to predict what happens in the next 10 years at all, right? But in the next 3 to 4 years, we have deflationary forces that are coming in, and the transient issues of energy go away, at least in terms of oil, Iran, that kind of stuff. So to me, once we get past this hurdle of the short-term oil issues, we will return to a deflationary environment, an environment that is, I shouldn't even say it's less inflationary. I don't think we're going to see numbers in the three-handle numbers. We're going to be seeing numbers down in the low twos, maybe even sub twos, but we're going to see that. And why is that important? Because ultimately for real estate, we are a completely interest rate dependent market. The good and the bad thing about real estate is we rely heavily on leverage. It's what allows us to make a lot of money, but it's also the thing that, you can get really screwed by. So if you think about it, who got screwed? Well, a lot of us got screwed. I got screwed. And it's people buying at low interest rates when rates were going high. Mm-hmm. So it stands to reason that if you buy today at lower basis, higher interest rates, that you're buying at the right time if you anticipate rates coming down even a little bit.
Well, and I like to pair that with, if you're going into an inflationary environment, as long as your debt is sustainable, let's say you have 5 to 10 year debt, your rates should eventually catch up to whatever this next round of inflation is going to hold. So even if the oil prices do, let's say, this takes 18 months to work out, you should start to see some of those base level expenses or income factors on the multifamily start to work themselves into your NOI.
Well, that's right. Listen, at the end of the day, inflation also means inflation of wages, right? So that's also part of it. But the problem is when inflation moves very quickly, right? When inflation moves quickly and rates follow, that's when that becomes a big problem.
Yep.
But the other thing to remember is that, if you look at multifamily, the fundamentals of multifamily are really quite good still, right? And you look at various markets, I mean, like the Carolinas, for example. I mean, lots of people still moving in, lots of jobs still going in. People don't stop living somewhere, right? And at the same time, because of those interest rates going up so much, you had a significant decrease in new builds. And we're starting to see that as well.
Yeah, and that there's a big lag between, new build starts and them actually coming online. It's not like a developer just puts a 200 unit online, 200 unit building online 6 weeks later type thing.
Right. Yeah. And a lot of those are on hold. So I think what you're looking at to me is a real setup, an opportunity for people who are paying attention to get in early on this next cycle, because the time it takes between this kind of malaise in the market to to froth can just be 3 or 4 years.
Mm-hmm.
So right now, I want to be a net buyer, and that's what we're doing.
So, do you see this as an opportunity of we're at a decent interest rate level now, and kind of as you mentioned, rates will come down, so you might see cap rates compress, or do you see that the income side of these buildings might be growing? We're going into an inflationary time, so we're going to see wages and rents increase, or is it a little bit of both? Where are you reading the gain here?
Yeah, I'm looking at it as right now. I think the bigger issue is interest rates. I think the bigger issue is interest rates. I think a lot of the trying to expect occupancies to go up just because of inflation is probably not realistic. Although there is a real issue with the housing market too, and affordability that drives people into rentals as well.
Yeah, I mean, when the interest rate goes up for multifamily, I mean, it's going up for the single family home buyers too, right?
Yeah. So the idea to me is like, if you can take right now what I think is, could rates tick up a little bit? Sure. But do I think they're going to tick up a lot? No, I think if they tick up, it'll be temporary, and I think we'll tick back down. But if you look at it that way, if you can find a property that you're getting at a great basis today that cash flows at today's rates, I think you are beautifully positioned for exiting in the next 3 to 5 years.
And so, I've been watching the 5-year Treasury a lot, and it doesn't seem to, even with some higher inflationary prints, we're not seeing the yield curve fall, right? We're not seeing rates come down at all. So, do you have any read on where you think your rates are going to be at over the next 12 months? Your crystal
I
ball's
mean,
broken too.
I think the issue with that again is just because there is a lot of instability in the markets. Anytime you get into things like Scott Bessent going to Japan and trying to talk the Japanese out of selling bonds, it's going to shake the bond market, right?
Mm-hmm.
But I think to that point, I think Bessent showed muscle, and he showed the world, listen, don't be shorting, don't be shorting Japanese yen. Don't assume that bonds are going to get sold off, because we're gonna come in and do what we need to support the economy. So you bring up a good point, and I do think though that, like, if you read the bond markets, what the bond markets really are telling you is what the bond investors believe is going to happen with the market, and that changes. It changes in real time based on what's going on in the geopolitical situation.
I think you brought up something there. You kind of just mentioned it, that I think people often forget, and even very sophisticated people forget, is that we always assume the market's going to move logically, or that the market's going to move naturally. And sometimes the government will step in and make things move in a very unnatural way, or, we're going to fix it, right? Because it can't implode. And people don't often assume that that's a possibility, because it's not a possibility if the public markets just worked completely free.
Well, remember that the U.S., it's not just about protecting investors, but the U.S. has an awful lot of debt that it needs to continue to refinance.
Mm-hmm.
So this is not optional for rates to come down. It is necessary. And I think that the Trump administration understands. I think Scott Bessent understands that. I think Kevin Warsh understands that. So, let's see what they can come up with.
So changing gears just a little bit, you've been part of more than one deal. You've done quite a bit. You've raised quite a bit of money. We've got a lot of passive investors that listen to our show. What are things that they should be looking out for in today's market, or things that they should be asking sponsors when they're analyzing deals?
I think, I think it's just you should be looking at it through the lens of somebody who's buying this on your own. And what do you do when you look at a property? In multifamily, there's the single biggest variable is, where is this property, right? And so where is this property, meaning, how many jobs are moving in, how many people are moving in, what's the local economy look like? Because that's very different from market to market. I think focusing on quality markets and then operators that you can trust, but the market first. And then I think you have to, when you're looking at the underwriting, you have to make sure that the underwriting does not look unrealistic, right? I mean, if you look at the underwriting right now and somebody's just assuming that interest rates are going to come down by 200 basis points, that's probably not a good idea if they're having to do that to make the deal work.
Yeah, most deals look good if you are buying at a 6 cap and selling at a 4, right? It's just going to work.
The point is, though, that from an underwriting standpoint, and you may believe that those cap rates will change. I mean, I happen to think they will change over the course of the next few years, but I don't think underwriting them is wise. I think you have to underwrite the deal with a fair amount of being conservative, right? So I think that's a big part of it. And again, the operator, understanding the ability, the competence of the operator is really important. And I think those are the big things, right?
Good. Dustin, what questions do you want to go with?
Yeah, I guess, Buck, on that last point, I know you've said before that the alpha is in places that Wall Street doesn't offer, and I'm kind of curious, do you view that more as the asset or more of the operator of that asset?
Well, I think what I'm talking about is the alpha, meaning the opportunity to, really make more money than your typical market, right? So your typical stock market. And I do think that is in real estate. I think that, you don't have to go back very long to see how much money people can make compared to money sitting in, in stocks, bonds, and mutual funds. I mean, these days, though, I will say that, the market is, I'm not gonna say the market has not performed well. It has performed extraordinarily well, but it's also probably in a bubble, I think my point on the alpha side is simply that, alternative assets really they provide, I think disproportionate rewards, with investments. So especially if you time it right, like now, it's just, man, it's great time it's a great time to invest, and that's funny because it's a time when less people want to invest because there's no froth in the market. So
kind of what you were saying earlier with the whole Warren Buffett thing, right? When people are fearful, be greedy.
I guess I do have one other question based on something you said earlier. I'm curious about, I guess, your thoughts on AI's impact to real assets specifically. I know you kind of said you think short-term deflationary, long-term will probably revert, but do you see impacts beyond that? Like, kind of how are you viewing real assets in the age of AI?
Yeah, I mean, I don't pretend to know what's going to happen, in the next 10 years because it's so unpredictable. And I'm just saying that I think AI inherently is deflationary. And so I do think that will provide us significant relief with interest rates and asset prices, therefore. I think long term, I think we've got a real potential problem in this country because, I mean, what is AI doing is replacing a lot of jobs. It's going to replace a lot of jobs. Maybe not in the next 5 years. I think people are maybe overestimating a little bit how quickly it's being adopted by businesses and that kind of thing. I think there are incremental increases in productivity, and I think you are going to see that in the numbers. I mean, law firms know they don't need, a bunch of junior guys doing stuff anymore. And you can automate a lot of things. So you're seeing some of that. But, 10 years from now, when we've got a bunch of Elon's robots around, I mean, that's a completely different ballgame, right? And
Yeah, when you can start to automate some of the physical side of it.
Yeah.
That's right. And when that happens, it becomes a real, who knows, it's a tricky thing, because it seems like you're going to have the side with assets, and you're going to have a side with nothing. And I do think that middle class is in real danger.
You talk to a ton of different investors, and you've seen a lot of people's different portfolios. Do you find that this is a time when people are reshaping their portfolios to match the current economic environments, or are people just riding the wave of the S&P 500?
I don't think that. I think most people who are riding the wave of the S&P 500 are happy to do so, and they may not be wrong. I mean, listen, even with real estate, there was some very very well-known syndicators that basically, once 2017 rolled around, just completely said, "Damn, it's too much froth in the market. I'm out," and lost a lot of opportunity to make it probably the most money that you could have in that period between 2016 and 2020. But I do think that I think there is just a tendency for people to look at their portfolios and performing well and just assume they'll continue doing so. I mean, it takes guts to actually invest in something that is not sexy, right? It takes guts to say, this has performed extremely well. I'm going to get out, and I'm going to invest in a market that has gotten its butt kicked.
Mm-hmm.
Even though intellectually that is the right thing to do. But it is, we don't run on intellect, in most people don't run on that in the investing world. So,
especially when you have, your more typical financial advisors and people of that realm, saying to stick in the stock market, right? And that these alternative assets are quote unquote unregistered, right?
Yeah. Well, they're never going to suggest pulling out of those markets, because their whole business model runs on assets under management, right? So, I mean, there's no incentive for a financial advisor to have a few $100,000, $1 million pulled out and lose that AUM. Yeah. So, I mean, that's why they're called alternative assets, right? I mean, what's so alternative about owning property? That definitely is something that's older than any equity market. So
that's what I've said that a few times on this show. They're always called alternative assets. I said, I think the stock market's the alternative, what people used to do for thousands of years, right? I mean, landlord is as old as time. Dustin, what other questions do you want to run with?
No, I don't. You've, Adam, as per usual, you've been reading my notes here. I do think, I guess a comment. I mean, I've had this conversation with investors a decent amount. Who are like, well, why, given the track record the last 4 years of the stock market, why should I, go to real estate that's going to be 12, maybe 15% when the market's been returning so much? And Buck, you kind of said earlier, maybe these folks aren't wrong. I tend to agree with you that we're probably in a bubble, but at the same time, bubbles can run on for a long time, right? And I think it's a matter of knowing when to, or how much risk you're really taking. I think the mistake that I see people is kind of exactly what you just said, was they will assume that the returns they've been getting in something like that, they're just going to keep going. And I can't help but feel, and I'm not calling for a stock market crash, but we have to revert to the mean, right? At some point, we've got so much data over so many years that unless there's been some massive structural change, I just don't see how we can continue, the stock market can continue printing years in the high teens and 20s and things like that. It doesn't seem like that's going to go on forever. And yet people, to your point, want to continue to believe that, like, well, I'm just going to ride this out until that's over, and they might be in for a very rough surprise when that actually is over.
Or maybe it's just a time to hedge a little bit, right? Doesn't mean
Sure.
you completely get out of the markets. I don't think, people should necessarily do that. But I do think it might make sense to look around and say, I've made a bunch of money. Maybe I should, invest in something where the markets are clearly not in a bubble, right? And it's interesting because, again, I don't pretend to know where this stock market's what's gonna happen, but Stanley Druckenmiller, the famous hedge fund guy, I think, he's like, never lost money or something. I don't know what crazy statistics he's got, but he was saying that because of the valuations, he does not believe over the course of the next 10 years that the stock market will yield meaningful return.
Yeah.
Mm-hmm.
And so that's a smart guy. I mean, smarter than me. Maybe he's right, maybe he's not, who knows? But bottom line is that I think when there's a lot of uncertainty, and I've learned this myself, when there's a lot of uncertainty and when you're way ahead, it's not a bad idea to take some chips off the table.
I mean, to the point that I think we're all making, if we were looking at an apartment building that had the price to earnings ratios of what some of these stocks are, no one would buy it. No one would loan on it. So,
Yeah.
Well, Dustin, I'm all set if you want to wrap up here.
Yeah, sure. So, Buck, we do like to ask all of our guests. We're the Wealth Independence podcast, and so those words, independence and freedom, it's very central to mine and Adam's worldview. We're curious what those words mean to you, how you live that, sort of how you think about freedom and independence.
Sorry. I don't have like these. I think independence and wealth and stuff. I think the terms can be really, suggest that you're like running around like Grant Cardone and his plane and that kind of thing. But the reality is that it could be as simple as not really worrying about paying your rent, not really worrying about going out to dinner, or how you're going to pay for college for your kids. It's simple stuff like that. That is wealth. That is independence. And if you can more and more make it so that you don't have to constantly be exchanging hours for that money, I mean, that is, I guess, true independence, right? So wealth is not worrying about stuff, and then independence is not you having to grind it out just to make ends meet. I think that's probably the best simplified kind of definitions I would have.
That's awesome. Well, Buck, we appreciate you coming on. I know you've got the podcast, you've got a fairly extensive online presence, but if folks want to connect with you or follow you, what's kind of the best way for them to do that?
Yeah, I think the best thing is if you're interested, I have a Wealth Formula podcast. Definitely check it out. I mean, this is the kind of stuff we talk about. We talk a lot about macroeconomics. We talk about some personal finance stuff, special topics here and there. But we've been doing it for a long time. It's really suited for people who are making some decent money already, and hopefully you'll find something meaningful there.
All right. Well, that was an excellent interview with Buck. We've had this one scheduled for a while. I was excited to get him on and get his points of view. I don't know, Adam, any quick takeaways from you?
Yeah, I mean, it's refreshing to hear some people's view on the real estate market, because I think too often you hear the doom and gloom of, why would you buy right now? Or, interest rates are up or cash flow is not super high. And I even have some mentors that have been doing this for a long time, and recently they've been a little down on the whole industry. And I think it's easy to look down on something when was so hot for a little while. But, to a lot of the points he made, I don't think this is a bad time to buy. I mean, we did a presentation last night about a deal that we're doing that's available for our investor club, and it is it's one of those things. Whenever we start a deal, I always feel very torn internally. Is this the right choice? Right? Did I run the numbers right? Did I do this right? Did I miss a number? Yeah. Because it's investor dollars, it's my dollars, it's the things we spend a lot of time with. Just because we can raise the money doesn't mean it's the best thing to do. And so I think the biggest takeaway I had from him is just that it was a bit of a refreshing view on the multifamily space.
Yeah. Yeah, I mean, I've certainly I've written about this a lot. I think that
On
I mean, there
what?
was never
What do
really
you write? What do you
I
write?
do, yes. Thank you for that Passive Perspectives newsletter, weekly on
Mm.
Fridays, same day as the podcast release. Go to passiveperspectives.com, sign up for the newsletter. But yeah, I think the multifamily fundamentals have been reasonably solid in. I mean, there's definitely still some markets where there's a lot of softness, and you would need to be buying to accommodate for that softness if you're buying in that market. But that doesn't necessarily mean that it's bad to buy there. You just got to be careful about buying at the right price. But that's really true anywhere, right? And then it comes down to the assumptions that are baking into it. And it's one of the things that, like, I there are times where there are more good deals than there are not good deals. And but that was even to say that, like, at the height of the market, that there weren't still good opportunities, right? It's just there were so many people that were chasing things, and people were getting into stuff that they shouldn't have been getting into. But there were still good deals that could have been done there. There just were fewer and far between. And I think we've definitely shifted, and we're seeing that, especially in multifamily, we're seeing that to where there are now getting to be more and more good deals. But you've got people that are gun shy, right? They once bitten, twice shy, right? They got it handed to them in the last couple of years, and they're afraid to go back into multifamily. And I think that the caution's warranted always, but you have to be willing to sort of step in and take advantage of those opportunities. He said, I wrote it down here, there's always something on sale. And I don't know that I would call multifamily on sale right now. I think it's a good opportunity, but to that point, there is always something,
Well, I
right? Go
mean,
ahead.
to the on sale point, most of the time you're able to buy currently at far below replacement cost.
Sure.
So whether or not that's on sale, I mean, it's cheaper than you could build it for.
Yeah.
So substantially most of the time. So
Yeah.
if I can buy something drastically below replacement costs, we're under the deal that we just recently underwrote. I keep tying back to this because all my time recently has been spent on it, but we're underwriting rents on a 2-bedroom at $1,400 3 years from now. Do you know how much a mortgage is on a 2-bedroom house in Northern California? I mean,
Yeah.
you're going to be paying $2,500 a year. So we're $1,000 gap from
Yeah.
home ownership,
Yep.
paying $120,000 a door when a single family home is 350 grand, 400 grand.
Yeah.
Maybe it's not the sale of a lifetime. It's not '08 cheap, but maybe it is '08 cheap when we look at this in 2035.
Sure. And I think that's the thing. You get a lot of people that's what they're looking for, right? They're like, "Oh, I'm waiting for the post GFC type sale," and that's not.
Maybe this is it.
Yeah, I think that we're sort of living through. To your exact point, Adam, I think 10 years from now, people are going to look back and be like, "Man, I wish I was loading up on real estate in 2026."
What does Robert Holmes say? That the best time to buy a single family home was 20 years ago, and the second best time is today.
Is now, yeah,
Yeah.
for sure. So yeah, I mean, I definitely agree with the real estate play, but that's also, you still have to be smart, right? There's still some people out there that are making ridiculous assumptions. Adam, when we were recording, you mentioned that any deal looks good if you say you're going to buy at a 6 cap and sell at a 4, right? Yeah. So like, you still got to pressure test some assumptions. Yes, there are some good things now, but like, is it realistic? Like, are the projected rents going to be, I mean, you can never know, but like, is it a realistic projection for the growth and the business plan? And then does the whole thing hinge on something around interest rates? That's a danger thing too. So there are good opportunities, but you got to still watch out for some of those landmines, because it's very, very easy to spreadsheet engineer a very good deal in this space.
It's even hard as a sponsor to not spreadsheet engineer, right?
Sure.
You're like, well, what if I just need it to be a little bit better, right? What if I
Yep.
do this? I mean, and most of the time, I think me and you sit here a lot of the time and we say, okay, well, let's just hold everything steady. And if we pull a few levers, does the whole thing crash and burn? If it doesn't crash and burn, then we're pretty comfortable buying a deal. My base case is cash flow. If we can get it to cash flow, probably fairly happy to own it. And I think that, we've talked about a few times on this podcast. There's a lot of people out there that are comparing it to the S&P 500, but that's part of your portfolio, the stock market, right? And I think there are probably other assets in people's portfolio. I at least know a lot of real estate investors sitting on a single family home making far below 5% total returns, and would make sense to move up into a larger multifamily deal with, and to Buck's point, less time being spent. His point on independence and not trading time for money is a huge one.
Yep. Yeah, and he made the point about even for folks that are sitting on maybe some large stock market gains. I liked that point of view of, okay, maybe the risk reward is starting to get too far in one direction. And he wasn't saying go sell all your stocks because there's about to be a crash, but it was like, look at it and say, we've made a lot of money. This has done really well. Why don't we take a little bit of risk off the table and move some of this to something else where there's still good opportunities? Like we're confident in a space, but maybe this one's gotten a little bit overextended. And I think that it goes back, you and I talk all the time about having a portfolio type mindset. I think that's really the right way to look at it, is not, I'm all in on this one thing, but how can I shift the pieces around based on my own goals, the larger, I'll call it the macro environment, but looking at a risk reward sort of view. And I really, really like that, because back to his first point, there are opportunities. There's always an opportunity somewhere. It's just a matter of finding it and then really being willing to, he sort of touched on this, but being willing to take action, right? It's hard to invest in some place where people are burned and don't want to do it. You hear some stories of some guys that backed up the truck in 2012 on residential real estate. And while that looks like, of course that's, so obvious now, they were
stupidest move they could ever make in 2012, right?
Exactly.
That's what it looked like.
That's exactly what it looked like. And you don't, we have the benefit of hindsight to know that was an amazing
that's
choice.
That's basically how Kiyosaki made all of his billions, right? I'm assuming he's worth north of $1 billion. It was buying the stupid investments in 2010 through 12.
Yep. The last point I'll make on this, I actually wrote about this in a newsletter a couple weeks ago, but when I used to read a lot from Stansberry Research. Interesting shop. If you can get past their marketing, they put out some really good stuff. And there was a guy there that had a publication, and his 3 criteria for a good investment were something that was cheap, or it was hated, cheap, and in an uptrend. And I absolutely love that. And I think that's it can be easy to find those things. You want the stuff that's hated, and typically because it's hated, it becomes cheap and it makes it a good buy. But you don't want to catch a falling knife, because unless there's an established uptrend, it might not be going somewhere. But what's left out of that is, again, you have to be willing to you got to have some conviction there and say, okay, there is an uptrend. We think we've got a good opportunity in the valuations here. We're going to go ahead and step in, because really once it's obvious to everybody, the opportunity's gone. There might still be some gains that can be made on the tail end, but the big opportunity is gone once everybody realizes that this thing maybe shouldn't be as hated as it has been.
And we can close this out, and I don't want to turn this into a stock market review, but when you look at all the stocks that are up right now, you could say, well, I'm in industrial, and I'm in AI, and I'm in software, and well, Caterpillar might not seem like an AI tech stock, but it's mainly getting bid up because it makes generators that are being used in AI data centers
and construction equipment that's being used to build AI infrastructure. Did you read, there was literally an article in the Wall Street Journal this morning about that, about how these odd picks and shovels plays for AI, traditional.
Yeah, they're selling shovels in an AI gold rush, right? That's they're the Levi Stratton.
Yep. Totally agree. Well, we won't prolong it. This has been a great episode. I was, like I said, I was happy when Buck agreed to come on, and I think we had a great conversation with him. But if you enjoyed this, do all the things that we always ask. Go give us a thumbs up and a subscribe on YouTube. No, a thumbs up, Adam. Thumbs up. There you go. Give us a 5-star rating on Apple Podcasts and a positive rating or whatever it is on Spotify. Yep. We're eventually going to learn that one day. Go do all those things. Let the computers know you're enjoying it. And it helps get the message out to more people. But with that, we'll call it a wrap, and we'll catch you on the next episode. Thanks again so much for being here. And just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.